Good morning. We begin tonight with a story that has largely escaped mainstream attention, yet its implications could reshape the investment landscape for millions of Americans. The world's largest asset management firm has recently executed a capital reallocation of extraordinary magnitude. This is not speculation. This is not based on market rumors or unverified reports. We are discussing a documented movement of financial resources that involves sums reaching into the trillions of dollars. The firm in question manages approximately $14 trillion in total assets, making it the single largest asset manager operating anywhere on the planet today. To understand the significance of this development, we must first establish the scale and influence of the institution we are discussing. This organization is not a typical hedge fund. It is not an individual commentator offering personal opinions about market direction. This is an entity that holds positions in nearly every major publicly traded company across multiple continents. Its reach extends into retirement accounts, pension funds, and institutional portfolios that touch the financial lives of everyday citizens. When an organization of this size makes strategic decisions about where to allocate capital, those decisions are not made casually. They are the result of extensive analysis, sophisticated modeling, and access to information resources that far exceed what individual investors can typically obtain. The specific move we are examining tonight involves an estimated $2 trillion in exposure that has been redirected away from United States markets toward emerging and non-domestic markets. To be absolutely clear, this does not represent a sudden collapse of American financial markets. It does not indicate that the United States economy is facing imminent failure. What it does indicate, however, is that institutional strategists have identified shifting patterns in where returns are likely to be generated in the coming periods. Capital, by its very nature, seeks the environment where it can grow most efficiently. This is not a matter of patriotism or loyalty to any particular nation. It is simply the mechanical reality of how global finance operates. Individual retail investors, the category that includes most Americans who participate in the stock market through personal accounts or retirement plans, typically respond to information after it has already been widely reported. A headline appears announcing a development. Investors read that headline. They experience an emotional reaction, either fear or enthusiasm, and then they act, either selling positions or purchasing new ones. This pattern is reactive by definition. Institutional investors, by contrast, operate differently. They reposition capital before the stories that explain their actions ever reach the general public. This is possible because institutional investors employ large teams of analysts. They purchase access to proprietary data sets that cost millions of dollars annually. They have relationships with policymakers, economists, and corporate executives that provide them with perspective that is not available to the general investing public. However, there is a practical method that allows individual investors to benefit from institutional decision-making without having access to the same resources. That method involves observing what institutions actually do with their capital, rather than listening to what they say in public statements. The movement of $2 trillion in managed assets is not a transaction that can be hidden. It leaves a trail. It appears in regulatory filings, in exchange-traded fund flows, and in the composition of institutional portfolios. By the time major financial news networks explain a trend to their audiences, that trend has often already attracted significant capital. The most profitable opportunities exist before they become obvious to the majority of market participants. The central question, therefore, is not whether American markets will continue to exist or function. The relevant question is where new growth will emerge in the global economy and how investors can position themselves to benefit from that growth. Financial markets do not reward emotional attachment to particular assets or particular countries. Markets reward positioning. They reward participants who correctly identify where capital is flowing and who establish positions before that flow becomes widely recognized. Before we examine specific investment vehicles that provide exposure to the trends we are discussing, it is essential to understand the mathematical and economic foundation that underlies this capital rotation. Recently, the purchasing power of the United States dollar has declined measurably. This means that even if an investment portfolio remains unchanged in nominal terms, the actual value of what that portfolio can purchase has decreased. Investors, particularly large institutional investors, are highly sensitive to this dynamic. They seek assets and markets that will provide returns sufficient not only to generate profit, but also to preserve and enhance purchasing power over time. Examining the performance data from the previous calendar year reveals a significant pattern. The German stock market generated returns of approximately 22%. The Japanese stock market produced returns of approximately 26%. International markets, measured as a broad category, delivered returns approaching 30%. In comparison, the S&P 500 index, which tracks 500 of the largest publicly traded companies in the United States, returned approximately 16%. 16% represents a positive return. It is not a loss. Many investors would be satisfied with such performance. However, when placed in context alongside the returns available in other developed markets, it becomes clear that investors who limited their exposure exclusively to United States equities may have foregone significant additional returns. There is an additional factor that amplifies the returns available from foreign investments during specific economic conditions. When the United States dollar weakens relative to other currencies, American investors who hold foreign assets experience what is known as a currency tailwind. To understand this concept, consider an American investor who purchases shares in a Japanese company. If that Japanese company's stock price increases by 10% measured in yen, and simultaneously the yen strengthens by 5% against the dollar, the American investor's return when converted back to dollars is not simply 10%. It is greater because the yen-denominated gains are now worth more when translated into dollars. This creates a compounding effect. The investor benefits both from the appreciation of the underlying asset and from the favorable movement in currency exchange rates. This discussion is not advocating for the complete abandonment of American investments. That would be neither practical nor advisable for most investors. The United States continues to lead the world in numerous sectors, particularly technology, artificial intelligence, aerospace, and defense. American companies remain at the forefront of innovation in many industries. However, diversification across geographic regions is a fundamental principle of sound portfolio construction. Recognizing that economic leadership and growth rates shift over time is not a rejection of American markets. It is simply an acknowledgement of reality. Capital flows toward the highest risk-adjusted returns available at any given moment in time. Understanding where those returns are currently being generated is essential for any investor seeking to optimize portfolio performance. The current environment presents several converging factors that are influencing institutional capital allocation decisions. Political uncertainty affects market behavior regardless of one's personal political views. Markets function most efficiently when participants can predict with reasonable confidence what policy environment will exist in the near to medium term. When that predictability decreases, when the range of possible policy outcomes widens, markets respond by demanding higher returns to compensate for increased uncertainty. This is not a political statement. It is an observation about how financial markets process information and price risk. Additionally, currency dynamics are creating pressure on dollar-denominated assets. When investors globally perceive that the dollar may weaken, they naturally seek to diversify into assets denominated in other currencies or into hard assets that maintain value independent of any single currency. This process has been underway for some time, and it has measurable consequences. According to available data, approximately $48 billion in foreign investment capital exited the United States during the previous year. This represents a net outflow, meaning that foreign investors, in aggregate, removed more capital from American markets than they added. This is a significant reversal from historical patterns and indicates a shift in how global investors view the relative attractiveness of different markets. The question then becomes not whether diversification is necessary, but how to implement it effectively. The challenge for most individual investors is that they lack the expertise, time, or resources to analyze individual foreign companies or to select which specific countries offer the best prospects. Making incorrect selections at the individual country or company level can result in poor performance or losses. Fortunately, there are investment vehicles designed specifically to address this challenge. Exchange-traded funds allow investors to gain exposure to broad baskets of international stocks through a single purchase. This approach spreads risk across multiple countries, multiple sectors, and multiple companies, reducing the impact of any single poor performer while still capturing the overall trend. The first such investment vehicle worth examining provides exposure to emerging markets. Emerging markets are countries whose economies are in the process of rapid development, but have not yet reached the income levels or institutional maturity of fully developed nations. These markets typically include countries such as China, India, Brazil, Taiwan, and others across Asia, Latin America, and other regions. The fundamental appeal of emerging markets lies in demographics and growth rates. Many emerging market countries have young, growing populations. Young populations contribute to economic growth in multiple ways. They provide labor for expanding industries. They consume goods and services as their incomes rise. They drive demand for housing, transportation, technology, and consumer products. In contrast, many developed nations, including the United States, face aging populations. An aging population creates different economic dynamics. There are proportionally fewer workers supporting each retiree. Consumer spending patterns shift toward healthcare and services rather than growth-oriented consumption. Innovation can continue, but the raw demographic drivers of economic expansion are less powerful. Emerging markets do not face these constraints to the same degree. Their demographic profiles are fundamentally different, and this creates a structural advantage for economic growth over multi-decade time horizons. Performance data from the previous year supports this thesis. A major emerging markets exchange-traded fund delivered returns of approximately 25%. This year, the price movement has been more moderate, with less dramatic volatility. Some investors might view this calmness as a negative signal, suggesting that momentum has been lost. However, institutional investors often view price consolidation differently. When an asset experiences a strong upward move and then enters a period of sideways or modest movement, it creates an opportunity for new capital to establish positions without chasing a rapidly rising price. Institutions typically do not purchase assets at their peak velocity. They accumulate during periods of relative calm, building positions gradually while prices are stable. Investing in emerging markets through a diversified fund at this stage could be compared to investing in American markets several decades ago, before they reached their current level of maturity and valuation. This is not a short-term trading opportunity. It is a long-term strategic allocation to regions that are likely to play increasingly important roles in the global economy over the next 10, 20, or 30 years. The growth that has already occurred in developed markets is largely reflected in current prices. The growth that has yet to occur in emerging markets represents the opportunity. The second investment vehicle that deserves attention focuses on a developed market that has surprised many observers with its recent performance. This vehicle provides exposure to Japan. At first mention, some investors may question the logic of investing in Japan. For many years, Japan was characterized as having a stagnant economy, low growth, and structural challenges that seemed insurmountable. However, recent data tells a different story. A Japan-focused exchange-traded fund experienced substantial gains recently, with year-to-date returns at one point reaching 71% and 12-month returns of approximately 24%. These are not the returns of a stagnant economy. These are the returns of a market undergoing significant structural change. What has changed in Japan? The answer involves corporate governance reform and currency dynamics. For decades, Japanese companies were criticized for prioritizing stability and employment over shareholder returns. Management teams were often insulated from shareholder pressure. Companies accumulated large cash reserves but did not return that cash to shareholders through dividends or buybacks. This is changing. Japanese companies are increasingly focusing on profitability, efficiency, and returns to shareholders. This shift is being driven both by domestic reform efforts and by pressure from international investors who now hold significant stakes in Japanese companies. Additionally, the Japanese yen has weakened considerably against other major currencies. While a weak currency presents challenges for consumers within Japan who must pay more for imported goods, it provides a substantial advantage for Japanese exporters. When the yen is weak, Japanese products become less expensive for foreign buyers. A car manufactured in Japan costs the same in yen to produce, but when that price is converted to dollars or euros, it becomes cheaper for foreign consumers. This increases demand for Japanese exports and boosts the profits of Japanese companies. Those profits, when converted back into dollars by American investors, benefit from the same currency dynamic discussed earlier. Japan also offers stability that is increasingly valued by institutional investors. The Japanese government is predictable. The country has established rule of law, strong property rights, and sophisticated financial markets. Japanese companies include some of the world's most recognizable brands in automotive, electronics, robotics, and other advanced manufacturing sectors. The combination of corporate reform, currency advantage, and political stability creates an environment that institutional investors find attractive. This is not merely a recovery story, where Japan is returning to some previous level of performance. It is a fundamental restructuring of how Japanese business operates, with implications that extend far into the future. For investors who prefer not to concentrate exposure in a single country, even one as large and diversified as Japan, there is a third option. This option provides even broader exposure to emerging markets through a fund that casts a wider net. This particular fund returned approximately 34% in the previous year. It is designed for investors who wish to make what is called a macro bet, meaning a bet on a large-scale economic trend rather than on specific companies or even specific countries. The thesis behind this type of investment is straightforward. If an investor believes that global economic growth will be faster outside the United States than within it, this type of fund provides comprehensive exposure to that growth. The fund includes exposure to rapidly developing economies across Asia, including India and various Southeast Asian nations, as well as markets in Latin America, Eastern Europe, and other regions. India, in particular, has attracted significant attention from institutional investors. With a population exceeding 1 billion people, a growing middle class, increasing technology sector development, and government policies aimed at encouraging investment, India represents one of the largest growth stories in the global economy. Singapore, while much smaller in population, has established itself as a financial and technology hub with sophisticated infrastructure and business-friendly policies. By holding a broad emerging markets fund, an investor gains exposure to all of these opportunities simultaneously, without needing to predict which specific country will perform best. Understanding the psychological dimension of investing during periods of market uncertainty is crucial. When headlines report political tensions, trade disputes, or geopolitical events, many investors experience anxiety. This anxiety often leads to selling positions, moving to cash, or making other reactive decisions. However, it is important to understand that institutional investors respond to these same headlines very differently. While individual investors may panic and sell, institutions are analyzing whether the situation creates opportunities to reallocate capital toward assets that have become temporarily less expensive. Money does not disappear from financial markets during periods of volatility. It simply moves from one set of assets to another, from one group of investors to another. Market pullbacks and periods of uncertainty are often the times when large institutional investors establish new positions. There is a principle that applies across all major market transitions. Every significant rotation of capital, every major shift in which assets or regions are attracting investment, feels uncomfortable and uncertain while it is occurring. It only feels obvious in retrospect, after the shift has largely completed and the majority of the gains have already been realized. If an investor waits until a trend feels completely safe and entirely clear, that investor is almost certainly arriving too late to capture the most attractive returns. Certainty in financial markets is expensive. By the time all uncertainty has been removed and all observers agree on a trend, prices have typically already adjusted to reflect that consensus. The opportunity has been competed away. This does not mean that investors should act recklessly or make decisions based on incomplete information. It means that some degree of uncertainty is inherent in any investment decision made at an advantageous time. Institutions do not have certainty. They have probabilities. They have models that suggest certain outcomes are more likely than others, but they do not have guaranteed knowledge of the future. What they do have is a process for analyzing information, making decisions based on that analysis, and accepting that some degree of uncertainty will always exist. Individual investors can adopt a similar approach. Rather than waiting for perfect clarity, investors can position themselves based on observable trends, including the movements of institutional capital, changes in currency values, shifts in economic growth rates, and other measurable factors. This does not mean selling all American stocks or abandoning domestic investments. Such a drastic move would be inappropriate for most investors. The United States economy remains the largest in the world. American companies continue to innovate and generate profits. Certain sectors within the American market are particularly well positioned. Defense-related companies, for example, benefit from government spending that is likely to remain substantial regardless of broader economic trends. Companies involved in rare earth minerals and strategic materials are benefiting from increased attention to supply chain security and the requirements of advanced manufacturing. Industrial companies that produce essential equipment and infrastructure components continue to perform well. These are areas within the American market that offer relative stability and growth potential. However, ignoring a global capital rotation of the magnitude currently underway represents a different kind of risk. When the world's largest asset manager redirects trillions of dollars in exposure, that action is based on analysis and conviction. Individual investors do not need to predict exactly what will happen in global markets over the next decade. They simply need to observe where capital is flowing and consider whether their own portfolios are positioned to benefit from those flows. Establishing positions early, before a trend becomes widely recognized, and then maintaining those positions with patience, allows the underlying economic forces to work in the investor's favor over time. There is another significant development occurring that many investors may not yet fully appreciate. It involves precious metals, specifically gold and silver, and it represents a change in how these assets are classified within the global financial system. For many years, major banks viewed gold primarily as a store of value, but not as a highly liquid asset that could be easily used in their operations. Gold was valuable, but it could not be readily deployed in the same way that cash or highly liquid securities could be deployed. This limited its utility from the perspective of bank treasury operations. Recently, however, there has been a reclassification. Gold is now being treated by major financial institutions as what is called a Tier 1 liquid asset. In practical terms, this means that large banks can now count their gold holdings as equivalent to cash when calculating their liquidity ratios and capital requirements. The implications of this change are significant. If a major bank holds gold and can now treat that gold as equivalent to cash, the bank can use that gold as collateral to obtain loans or to support leveraged positions in other assets. Previously, gold simply sat in a vault. It was an asset, but it was not an active part of the bank's operational liquidity. Now it is. This changes the incentive structure for banks. If gold can be used as high-quality collateral and counted as liquid capital, banks have a stronger incentive to hold more gold. This is not about fear of economic collapse or doomsday scenarios. This is about practical balance sheet management and regulatory capital treatment. When the largest financial institutions in the world realize they can use gold not just as a hedge but as an operational asset, they naturally seek to acquire more of it. This helps explain why gold prices have reached historically high levels recently. The traditional explanation for rising gold prices involves fear and uncertainty. Investors buy gold when they are worried about inflation, currency devaluation, or geopolitical instability. Those factors certainly play a role. However, the reclassification of gold as a Tier 1 asset provides an additional, perhaps more fundamental, explanation. Gold is being purchased not only by investors seeking safety, but also by institutions seeking to optimize their capital structure under the new regulatory treatment. This creates sustained demand that is less dependent on emotional sentiment and more dependent on institutional balance sheet management. For individual investors, this development has implications even if they do not directly own gold or gold-related investments. Many individual investors hold retirement accounts that include funds managed by large institutions. Those institutions are making decisions about asset allocation based on these regulatory changes. The value of diversified portfolios, the returns generated by balanced funds, and the risk profile of retirement accounts are all influenced by these shifts in how major assets are classified and utilized by large financial institutions. Understanding these changes provides context for broader market movements and helps explain why certain assets are performing differently than they have in the past. Managing emotions during periods of market volatility requires understanding the patterns that tend to repeat during such periods. Observing market behavior over multiple economic and political cycles reveals consistent patterns. Negative news and significant policy announcements often occur when markets are closed, particularly over weekends. The practical effect of this timing is that investors have extended periods to absorb the information without being able to act immediately. During those hours or days, anxiety can build. Investors read commentary, watch analysts discuss worst-case scenarios, and imagine negative outcomes. By the time markets reopen, many investors are prepared to sell positions simply to reduce their psychological discomfort. This creates predictable price movements. Markets open lower, some investors sell, prices decline further. Throughout the initial day or days following negative news, uncertainty remains high. However, often within a short period, subsequent developments emerge. Negotiations begin. Officials make statements suggesting that situations are less dire than initially feared. Clarifications are issued, and frequently within days, markets reverse their initial negative reaction, prices recover. Investors who sold in panic realize they locked in losses unnecessarily. Institutional investors who purchased assets at temporarily depressed prices benefit from the subsequent recovery. This pattern has repeated numerous times across different political administrations and different types of crises. It is not unique to any particular leader or any specific policy. It is a pattern inherent in how markets process uncertainty and how human psychology responds to threatening information. Investors who understand this pattern can avoid being victimized by it. Rather than reacting immediately to negative news, particularly news released when markets are closed, informed investors can wait. They can observe how the situation develops over several days. They can recognize that initial reactions are often extreme and that subsequent clarifications typically moderate those reactions. Currently, similar dynamics are at play. Policy announcements are made with limited specific detail. The lack of detail is intentional. It maintains flexibility for policymakers, but it also maintains uncertainty for markets. Uncertainty, as discussed earlier, typically causes markets to decline as investors demand higher returns to compensate for increased risk. However, this uncertainty is often resolved relatively quickly as details emerge, negotiations progress, and the actual implementation of policies becomes clearer. Investors who can tolerate short-term volatility and who understand that uncertainty is temporary are better positioned to benefit from the eventual resolution. The financial system, particularly as experienced by individual investors through trading platforms and financial news media, is designed to capture attention and provoke emotional responses. Rapidly updating prices displayed in red and green, breaking news alerts, dramatic headlines, and constant commentary all serve to keep investors engaged and reactive. The platforms benefit from engagement. The more frequently an investor checks their account, the more advertising they see, the more trades they potentially make, and the more revenue the platform generates. However, constant engagement is not beneficial for most investors' actual financial outcomes. Frequent checking of account balances during volatile periods increases the likelihood of making emotional decisions that harm long-term returns. The advice for investors, therefore, is to resist the urge to constantly monitor positions during periods of high volatility. Closing the application, stepping away from financial news, and returning to review positions only when able to do so from a calm and analytical mindset produces better outcomes. This is not easy. The psychological pull to check, to know, to do something is powerful. But discipline in this area is one of the most valuable skills an investor can develop. Markets will continue to fluctuate. News will continue to be dramatic. But long-term investment success depends not on reacting to every fluctuation, but on maintaining positions in quality assets through periods of volatility and allowing those assets to appreciate over time. Understanding that volatility and uncertainty are not threats, but rather inherent features of markets allows investors to maintain perspective. Every significant investment opportunity in history has been accompanied by uncertainty. Investors who purchased American stocks during the 2008 financial crisis, when uncertainty was at its peak, achieved exceptional returns over the subsequent decade. Investors who purchased technology stocks during the early 2000s downturn, when the sector was deeply out of favor, similarly benefited enormously. The pattern is consistent. The best opportunities emerge during periods when most investors are too frightened to act. Institutions understand this, which is why they often increase their positions during market declines. The current environment presents exactly this type of opportunity. A major capital rotation is underway. Institutional money is moving toward specific regions and asset classes based on analysis of growth potential, currency trends, and policy developments. This rotation is occurring while many individual investors remain uncertain, focused primarily on domestic markets, and hesitant to look beyond familiar assets. This gap between institutional positioning and retail awareness creates opportunity. It will not last indefinitely. As the trends become more obvious, as performance data accumulates, and as financial media begins to report extensively on international market outperformance, more capital will flow toward these opportunities. Prices will adjust. The window for establishing positions at favorable valuations will narrow. The evidence is clear. Asset flows are shifting. Performance data supports the thesis that international markets, particularly emerging markets and reform-developed markets like Japan, are generating superior returns. Currency dynamics favor these investments for dollar-based investors. Demographic trends support long-term growth in younger economies. Regulatory changes are enhancing the attractiveness of certain asset classes, including precious metals. All of these factors are observable and measurable. They are not predictions. They are descriptions of current reality. Investors who position themselves based on this reality, rather than waiting for absolute certainty that will only arrive after the opportunity has largely passed, place themselves in a position to benefit from one of the most significant capital rotations in recent memory. This brings us to the close of Part 1. We have established the scale of the capital movement underway, examined the institutional logic behind it, explored the specific investment vehicles that provide exposure to the trends driving this movement, and discussed the psychological challenges that prevent many investors from acting on available information. In the subsequent parts, we will examine additional dimensions of this story, including specific sectors that thrive during periods of geopolitical tension, further analysis of currency dynamics, deeper exploration of emerging market opportunities, and practical implementation strategies for individual investors seeking to reposition their portfolios. This is a developing story with significant implications for anyone with retirement savings, investment accounts, or long-term financial goals. The movement of trillions of dollars in institutional capital does not occur in isolation. It creates ripples throughout the entire financial system, affecting valuations, creating opportunities, and redistributing returns across different asset classes and geographic regions. Understanding these movements and positioning accordingly is not about speculation or taking excessive risk. It is about informed allocation based on observable trends and institutional behavior. That is the foundation of sound long-term investing. And it is the path that separates investors who merely participate in markets from those who systematically build wealth over time. We will continue this discussion in the next segment,